When multinational corporations, massive global banks, or even the federal government are sitting on billions of dollars in cash, they absolutely do not just leave it sitting in a standard checking account. Instead, they use this fascinating, high-speed ecosystem known as the money market.
We've got a lot of ground to cover today, so here's our roadmap. 1. Welcome to the money market. 2. The big 5 instruments. 3. Borrowers versus lenders. And finally, 4. How everyday investors participate.
Let's kick things off with Section 1, Welcome to the Money Market.
Okay, so the absolute most crucial thing to grasp here is that the money market is essentially a highly liquid, short-term holding area for massive, massive amounts of cash. We are dealing exclusively in debt securities that mature in a year or less. And honestly, sometimes we're talking just a few days or literally overnight. Because these assets are so short-term and the institutions behind them are so rock solid, they act as virtual cash equivalents. You can pull your money out at a moment's notice. This comparison really nails the difference between where you park your money and where you grow it. Think of it like this. If capital markets, stocks and long-term bonds are the foundation of a skyscraper, money markets are the quick in and out parking lot right out front. Capital markets are for raising long-term funds and taking on higher risk. The money market, well, that's just about keeping cash flowing smoothly, giving you a modest return with absolute maximum safety.
Moving right along to Section 2, the big 5 instruments.
Now, you might be sitting there wondering, how exactly do massive institutions park billions of dollars safely overnight? Well, they don't just rely on one single method. They actually have a whole toolkit of highly specialized instruments. And which one they use just depends on exactly how long they need to park the cash and, how much risk they're willing to stomach. Take a look at this cheat sheet. It gives us a great rapid-fire overview of the 5 primary instruments broken down by who issues them and their relative risk. We're looking at treasury bills, certificates of deposit, commercial paper, repos, and bankers' acceptances. But keep in mind, this is a wholesale market. These aren't the kinds of things you pick up for $50. They're traded over the counter, typically in these giant blocks of $1 million or more. Let's start with the absolute bedrock, T-bills. These are the safest tool in the entire kit. Because they're backed by the full faith and credit of the US government, they carry virtually zero default risk. But what's really unique here is they don't actually pay a traditional interest coupon. Instead, they're sold at a discount. So you buy it for slightly less than its face value, and when it matures in, say, 3 or 6 months, the government hands you the full amount. Plus, the income is completely exempt from state and local taxes. It is the ultimate safe haven. Next up, certificates of deposits, or CDs. Now, you've probably seen retail CDs advertised at your local bank, but the money market plays in a completely different league. These are large, wholesale, negotiable CDs, usually starting at a cool $100,000 or even $1 million. Unlike your standard savings account, these lock in funds for a set period to guarantee a really attractive rate. And the best part? Because they're negotiable, investors can easily just sell them to someone else on the secondary market if they need their cash back early. Now, this is wild. Just look at the explosive historical growth of commercial paper. Commercial paper is basically a short-term, unsecured corporate IOU. When a highly rated corporation needs cash fast, they issue this paper. But here's the catch. It's unsecured. That means there's no collateral backing it up, literally just a promise to pay. So investors are relying entirely on the stellar creditworthiness of that specific company. It's a tiny bit riskier than a T-bill, sure, but you get a higher interest rate for taking on that extra risk. So why the strict 270-day limit on commercial paper? Well, it's a massive shortcut. By keeping the debt maturity under that 270-day threshold, these corporations completely avoid expensive, time-consuming SEC registration and red tape. It's brilliant, actually. They bypass all those public disclosure rules for long-term debt and can raise hundreds of millions of dollars almost instantly to cover immediate short-term needs, like, say, making Friday's payroll. All right, tool number 4, the Repurchase Agreement, or Repo. These are heavily used by banks and the Federal Reserve to manage daily liquidity. Think of a repo as a highly secure, super short-term pawn shop transaction. A borrower essentially sells a super safe security, usually a treasury bill, to a lender for cash and explicitly agrees to buy it back the very next day for slightly more money. That treasury bill acts as absolute, perfect collateral. And finally, we have bankers' acceptances. These basically act like bank-guaranteed post-dated checks. And as you can see, they are the absolute vital engine for international trade. Say an American importer wants to buy goods from a foreign exporter, but they don't really know or trust each other yet. The importer gets their bank to accept a time draft.
unconditionally guaranteeing payment on a future date. That draft can then be sold right into the money market to raise the exact cash needed today.
Let's pivot slightly to Section 3, borrowers versus lenders. At the end of the day, the money market is really just a giant matchmaking service. It exists perfectly to match massive entities that need temporary cash with entities looking to earn a safe return on their extra cash. On one side, you've got borrowers, like the US Treasury needing cash right before tax season or a corporation short on inventory funds. On the other side, you have the lenders, massive banks or investors just sitting on a mountain of idle cash. The market seamlessly brings them together.
Okay, bringing it all home with Section 4, how everyday investors participate.
Now, you're probably thinking, this all sounds great, but I definitely don't have a spare $1 million laying around to buy a wholesale CD. And you'd be right, because this is a wholesale market. These instruments are traded in giant chunks, making it a highly exclusive club. For decades, everyday retail investors were basically locked out of the competitive, safe interest rates that the big players in the money market were getting. But then came a total game changer, money market mutual funds, or MMFs. These are essentially the ultimate workaround. They pooled together the savings of thousands of everyday people to grant them access to those high-yield Big Five wholesale instruments. By combining forces, the funds managers can go out and buy those massive treasury blocks and commercial paper on your behalf. So you finally get wholesale yields without needing $1 million to get your foot in the door.
What makes these funds so incredibly unique is that they manage their assets to maintain a rock-solid net asset value of exactly $1 per share. Unlike stock funds where the price is just bouncing up and down all day, a money market fund is engineered to essentially never drop below that $1 mark. If it does, that's called breaking the buck, and it's extraordinarily rare. Any extra value the fund generates is simply skimmed off the top and paid directly to you as a steady stream of interest.
So now that you know how the financial heavyweights manage their cash, I have to ask, is your own short-term cash working hard enough for you? Are you taking advantage of these highly liquid, super safe instruments through a money market fund? Or is your hard-earned money just sitting in a regular account slowly losing its buying power to inflation? In a world where giant institutions fight tooth and nail for every single penny of yield, can you really afford not to treat your own wallet like a wholesale bank?